757%. Seriously, just lock that number in your brain right now because we're going to be talking about it a lot today. Welcome to the EDR Brief. Today, we're cracking open the Q1 fiscal 2027 10Q from Dell Technologies, filed in May 2026, and we are translating it into plain English. Quick note before we dive in. We're entirely independent, not affiliated with the SEC, and absolutely not financial advisors. We use AI to help summarize these filings, so errors can happen. Always verify on sec.gov before making any money decisions. All right, let's get right into it.
So, about that number, 757%. That is the year-over-year revenue growth of Dell's AI-optimized server business. I mean, we all remember Dell, right? The slow, steady company that sold you that chunky laptop you took to college? Well, scratch that image. This filing paints a totally different picture. This is the story of a corporate tortoise that woke up, strapped a jetpack to its shell, and decided to become the hare. But to understand how a legacy hardware dinosaur actually pulled this off, we really need to look at how their business is structured today.
So Dell basically splits its massive empire into two main kingdoms with, very standard corporate acronyms. First up is ISG, or the Infrastructure Solutions Group. Think of this as the heavy machinery, massive data centers, complex storage networks, and those blazing fast new AI servers. Then there's CSG, the Client Solutions Group. This is the Dell you probably know best. The everyday laptops, desktops, and the monitors probably sitting on your desk right now.
Now, when you actually break down where the money is coming from, it's wild. The infrastructure side, ISG, pulled in an astonishing $29 billion this quarter alone. Meanwhile, the traditional PC side, CSG, brought in $14.6 billion. Just look at that split. The heavy machinery side of the business has completely dwarfed the everyday PC side. It's a seismic shift in Dell's entire financial foundation.
To really picture what's happening here, think of selling PCs like selling vending machines. You sell one to an office, make a nice little profit, and maybe you come back in 3 years when it breaks. Pretty simple. But selling AI infrastructure, that is literally like building the power grid for a brand new massive digital city. Every major tech company in the world is scrambling to build out AI right now, and Dell is basically selling them the high voltage lines, the transformers, and the concrete to make it happen.
So how does the cash actually flow through this power grid? Well, money comes in through one-time hardware sales, right? A company buys a server rack, they pay for it, boom. But Dell is also aggressively pushing subscriptions and as-a-service models, basically turning massive IT expenses into a recurring monthly utility bill for these corporations. But here's the catch. Where does all that money go? A massive chunk of it pours right back out into an incredibly expensive global supply chain. To build these AI servers, Dell has to buy ultra-expensive memory chips and components. And as we're going to see, that creates a fascinating tug-of-war on their balance sheet.
Which brings us perfectly to the AI scorecard. Let's look at the numbers that actually matter.
So let's strip away all the AI hype and ask, are more dollars actually walking in the door? Yes, they absolutely are. Total net revenue rocketed from $23.3 billion in the first quarter of last year to $43.8 billion this year. That is an 88% jump in total revenue. For a mature legacy hardware company, an 88% leap in a single year isn't just a good quarter, it's historic. It really shows just how aggressively the entire global economy is rushing to build out its AI capacity.
But here's the central paradox of this entire 10Q filing. Let's talk gross margin. That's how much money sticks around after making the product, but before paying for overhead like rent and corporate salaries. Dell's total gross margin dollars jumped from $4.9 billion to $7.8 billion. Sounds amazing, right? But wait, the gross margin rate, the actual percentage of each dollar they get to keep, dropped. It went from 21.1% down to 17.8%. Why? Well, because those specialized AI servers are ridiculously expensive to build. Dell is making way more total dollars, sure, but they get to keep a much smaller slice of every dollar they take in.
Still, despite that margin squeeze, the sheer volume of sales is just overpowering their costs. Dell's operating income for the quarter hit an astounding $3.65 billion. Remember, operating income is the crucial metric that shows the real profit generated directly from selling products and services before any fancy financing tricks or tax magic. And that number? It's up a massive 214% from last year.
And as we always say here on the EDGAR Brief, accounting profit can be fiction, but cold hard cash in the bank is not. Dell reported a free cash flow of $3.1 billion. Free cash flow is the real, tangible money left over after the company has run the day-to-day business, paid its bills, and bought all its necessary equipment. Sitting on $3.1 billion in pure cash generated in just a single quarter? That gives a business incredible flexibility.
So, the numbers are booming, but what actually protects this business? Let's check the Dell moat.
If AI servers are so wildly lucrative right now, why can't a competitor just swoop in and steal this momentum? Well, Dell has a few incredibly durable advantages. First is massive global scale. Literally, very few companies on Earth can secure the rare components needed for AI servers the way Dell can. Second, enterprise switching costs. Once a massive Fortune 500 company builds its data center using Dell's ecosystem, ripping it all out to switch to a competitor is just an absolute nightmare. It's too painful, so they stay. But the third part of their moat is something a lot of folks completely overlook: Dell Financial Services.
Check this out. In this quarter alone, Dell originated $2.8 billion in new financing. Dell essentially operates a built-in bank just for its customers. These AI server arrays are violently expensive, and most businesses simply can't write a check for them outright. But because Dell can offer in-house financing, leasing, and utility models, they make it incredibly easy for a customer to say yes to a massive upgrade. It is a huge competitive weapon.
But look, it's not all sunshine and rainbows. Let's move to reading between the lines, management's discussion and analysis.
Let's see if management is being straight with us about the headwinds. They actually wrote this exact phrase in the filing. Strong and accelerating industry demand for AI-optimized solutions has resulted in global supply constraints and substantial inflation in memory component costs. Honestly, I appreciate this because they aren't burying the lead here. They are openly flagging a painful reality. Everyone wants AI servers, which means the memory chips needed to build them are getting incredibly expensive and painfully hard to find.
And then they follow it up with this quote, sort of bracing investors for the future. We expect margin growth, while balancing anticipated margin rate pressure resulting from a continuing shift in mix towards our AI-optimized servers offerings. The plain English translation, as they sell more of these hot new AI servers, their overall profit margin percentages are going to keep taking a hit. They're setting expectations right now that this hypergrowth is going to come at a premium.
Which naturally leads us to red flags. What could go wrong?
If you read the standard risk factors, the corporate lawyers will tell you the sky might fall. But cutting past all that legal boilerplate, what are the actual threats right now? There are 3 real risks staring us in the face. Number 1, severe component supply bottlenecks. If Dell literally cannot get the chips, they can't sell the servers, no matter how high customer demand gets. Number 2, heavy reliance on this AI server trend. That 757% growth is doing a lot of the heavy lifting. If the corporate AI hype cools off even a tiny bit, Dell's overall numbers could swing wildly in the other direction. And number 3, the complex debt structures needed to fund their internal bank.
Take a look at Exhibit 10.1 of this filing. You'll see Dell just signed a massive new $6 billion credit agreement. Running a $2.8 billion a quarter internal financing arm means you need a ton of your own borrowed cash to make those customer loans. It requires really complex, heavy borrowing. Now, while they're managing it well right now, massive debt loads are always a critical, vital sign that investors absolutely must monitor, especially if interest rates start to fluctuate.
All right, let's bring it all together for the bottom line in our final verdict on this filing.
Look, Dell is a former cash cow tortoise that is rapidly transforming into a hyper-growth infrastructure hare. They've successfully positioned themselves as the go-to builders of the modern AI power grid, backed by that super sticky moat of Dell Financial Services. But that hypergrowth isn't coming cheap. Going forward, the absolute vital metrics to watch are their component costs and those shrinking gross margin rates.
Which leaves us with the billion-dollar question for next quarter. As this AI arms race continues, can Dell maintain its pricing power with its massive enterprise customers? Or will skyrocketing memory chip costs end up eating all their hard-earned AI profits? That's your EDGAR brief on Dell Technologies. Remember, this was just an explainer, not a recommendation. If anything piqued your curiosity, definitely go read the original filing over on sec.gov. Thanks so much for learning with us today, and I'll see you in the next filing.